Hey everyone, welcome back to the Chain Reaction Podcast. I'm your host, Tom Shaughnessy, a co-founder and principal at Delphi Digital. This week we have a very special episode. We're sharing Delphi Digital's monthly analyst call with our listeners. On this call, we dove into the massive Ethereum report we released, an update on Enjin, which we also recently released, and a breakdown of smart contract competition following the launch of Cosmos, in addition to so much more. This call happens monthly for our institutional clients and will be for members only moving forward. The call includes all 5 analysts at Delphi Digital, including myself, Kevin Kelly, Jan Lieberman, Anil Lula, and Medeo DeMarco. To ensure that you're able to submit questions moving forward and receive our analyst calls like clockwork, visit delphidigital.io on your device to sign up now. We have insights packages and an institutional offering. With that, let's jump into the conference call.
Hello, and welcome everybody to the Delphi Digital March Analyst Call. I'm Kevin Kelly, one of the co-founders here at Delphi, and we're excited to share our views on both the crypto market at large, as well as go over some updates and additional context behind some of the recent reports that we've released. Really quickly, just before we get started, a couple housekeeping items. We're recording this on March 14th, so Thursday afternoon. If anybody has any follow-up questions about anything we discussed today, please don't hesitate to reach out to us. As you know, we're constantly looking for feedback. I always enjoy the opportunities we get to talk crypto with our clients. It's important to note, however, everything we discuss here today is the opinion of our research team and should not be taken as investment advice. Everyone should do their own due diligence and assess the risk tolerance before making any type of investment decision, especially when it comes to the crypto markets. So we're going to start off today giving a quick overview or outlook on the broader crypto market before diving into an update and discussion around our Bitcoin monthly outlook. We'll also go over some of our recent Ethereum report released last week, what's going on in the competitive landscape there, a bit of color around the recent Cosmos launch, before pivoting to Enjin to give an update on what's going on with that, which is one of the most, or I should say, best performing crypto assets in the market in recent weeks. Finally, we'll round it out with some Q&A from questions that many of you submitted, which we're very thankful for, by the way. So with that being said, let's get right into it. So just kind of looking at the broader outlook for the crypto market, it's interesting. It appears where the market's kind of getting to or approaching a critical inflection point. Obviously, the value of the crypto market, as we all know, is still down over 80% from the January 2018 peak. But we are starting to see some signs of life here in recent weeks with this most recent rally and some of the smaller value names, some of the small caps. And it's still a bit too early to really tell whether this recent rebound is anything more than that, or anything more than just a bear rally. The fundamental backdrop is still a bit mixed, broadly speaking, across the crypto market. But it's safe to say, that Bitcoin and crypto is certainly far from dead, despite what some of the headlines may say. Two of the major kind of trends that we're watching that we wanted to touch on. The first is just intra-market correlations, between crypto assets are certainly starting to show a bit of signs of a bit of dispersion creeping back into this market, but the correlations between crypto assets still remains, extremely high, near all-time highs, in fact. But it is a trend we're monitoring very closely. Until we really start to see some of those correlations break down, we'd expect crypto assets to pretty much trade, relatively in line with one another. But it is something that we're actively monitoring to see, if some cracks start to form and we do start to see some return dispersion, within this market. The second trend that we've been looking at and really hitting on recently is kind of if we take a step back and looking at kind of broader macro trends. One trend we've been watching is this broader macro risk on versus risk off environment. And anyone who's familiar with the equity markets and traditional markets knows that it's been a pretty tumultuous time over the last 6 months or so, or I should say, the period between September and really kind of early 2019. Stocks have since recently rebounded and are pushing kind of past some key technical levels even today. But what is really interesting is again taking a step back and putting this in context. This risk-off move, towards the end of 2018, where you had concerns about, further Fed tightening, with interest rate hikes, trade war escalating, with China, which still isn't, resolved, and these risky asset classes like equities and stocks were really hit hard. But now what we've seen recently is this kind of risk-on environment come back to fruition. You have global central banks starting to really kind of walk back from tighter monetary policy for a number of different reasons, both here in the U.S. with some of the Fed's most recent commentary, but also abroad as well, or internationally. The ECB come out just last week, pushing out their timeline for when they think they'll be able to actually start hiking interest rates there, because the Eurozone continues to struggle with spurring economic growth. So, what does that mean for the crypto market, kind of tying it back, especially Bitcoin being the largest and most liquid? If we do start to see this kind of risk-on environment take hold, that should be, at least in the near term, potentially bullish for Bitcoin and other crypto assets, because again, we've written pretty extensively on the long-term kind of store of value thesis behind the digital gold thesis behind Bitcoin, and we firmly stand behind that. But the harsh reality right now, especially for people who are crypto enthusiasts, you could say, is that Bitcoin and crypto assets still continue to be looked at as more of a risk type asset class, right? Or kind of a risk on move is when you would hopefully expect to see them outperform. Not necessarily, when it's not really the flight to safety or safe haven asset. But long term, we think it eventually could be this complement to actual gold. So again, if we do see a risk on environment, we continue to see equity markets trend higher, that should be at least all else held equal bullish for crypto assets in the short term. What is interesting to note, though, and this is probably just more so a function of the parabolic price move in crypto asset prices towards the end of 2017, early 2018, and then the obviously subsequent crash in prices, is that you really haven't seen the short-term correlation. And Bitcoin's often regarded as an uncorrelated asset. What you've seen recently is over the last 12, 16 months, that short-term correlations between Bitcoin and stocks, right? So riskier asset classes actually does increase or heightens during periods in which you have these sell-offs or these risk-off moves. So it's kind of this uncorrelated asset until things go south, and then Bitcoin also sells off with some of these riskier asset classes. That's something, obviously, as this market matures and you start to see a more kind of heavier institutional presence, that's not something we expect to be a long-term trend, but it is certainly something that we're monitoring that's interesting because, again, this whole digital gold narrative is certainly a long-term view that we have, but in the short term, it's certainly not how Bitcoin is active. And with that being said, one quick question we got from just about everybody who reached out to us was talking about whether we think the bottom for prices are in. And while that's obviously a pretty speculative type of answer we could give, I definitely want to pass things off to one of my partners, Jan Lieberman, to discuss his thoughts around that, because he's really been pioneering the UTXO analysis for our team. So with that, I'll hand it off to Jan.
Thank you, Kevin. So one metric we believe is valuable to track is the aggregate age of UTXOs. So analyzing Bitcoin's aggregate UTXO age distribution over time gives us insight into the buying and selling patterns of previous market cycles. And this allows us to forecast where we are in relation to prior cycles and what we can likely expect going forward. So one of the major trends within UTXOs that we track is the portion of the UTXOs that are at least 1 year old. And since both the original write-up, which was dated as of the end of November, and the update, which included data up until January, UTXO holder dynamics have continued to trend mostly as expected. The 1 year UTXO holding rate climbed from 52% as of the first update in November to 57% as of the end of January, and now we're sitting at 60.3%, which we're now approaching the highs of the previous bull market previous accumulation pattern. And this really shows that the accumulation process is in full effect. And at the same time, we've noticed a decrease in the 3 to 5 year holders, and as well as other levels of holders where they've either been decreasing or stayed flat. And aside from this slight decline, there really hasn't been much selling from holders as prices have temporarily leveled off over the past several months. We don't believe that they have much capacity left to sell, and this is something we cover in depth in our upcoming Bitcoin Monthly Outlook. So looking forward, we still believe that the bottom will occur by the end of Q1 if it hasn't already. For some additional context, the bottom of the previous cycle occurred 68% of the way up from the 1 year holding bottom to the holding top. And at our current point, based on where we forecast the holding top to kind of come in, we're already 72.3% of the way there. Another metric we track closely, but we believe is starting to lose significance, is the NVTS ratio. And that currently sits at about 130, which is up significantly from the beginning of February where it was 90, which typically would be, bearish signal. But price is only up slightly over that time. And the reason it's ticked up so much is that we saw the high on-chain volume from late November and early December during those volatile times roll off and no longer be included in that 90-day moving average in the denominator. Some other reasons why we believe that metric is starting to lose its value is that you have the launch of Liquid and Lightning, which takes away from the underlying on-chain volume, but doesn't actually negatively affect that ratio or negatively affect that multiple. So that's one of the reasons. And the major reason we kind of see that change is just a general narrative shift within Bitcoin itself, where it's going. It was normally proclaimed to be, more of a peerless peer-to-peer currency, and now it's starting to shift towards more of a digital gold. And the reason that affects this ratio is because if you're thinking about what it actually entails is market cap and on-chain volume, and to negatively impact its value as a store value and as digital gold because there's less of it being transacted doesn't necessarily make sense. So something we're looking into is kind of understanding better ways to really analyze that and account for this change in narrative over time to provide more transparency and to have this metric continue to provide value.
Yeah, you bring up some really interesting points, and this is something we've talked about, internally a ton recently, because something like an METS ratio oftentimes is compared to, like a price to earnings for the stock market or for a stock, and while we see the merit in trying to find these different indicators, right, to be able to understand where we are in these market cycles, and to give us some type of insight in where we might be, it's certainly not an apples to apples comparison, looking at something like an METS to price earnings ratio within the equity market, for example. People are what's great about this space is that there are these different indicators that have certainly started to develop. One thing people watch and that we monitor because we know a lot of people out there are watching it are the margin long short ratio, for example, on Bitfinex that they put out. Again, it's not entirely representative of the entire market, but it is kind of an interesting indicator to watch for to see some of these kind of short-term price action kind of gives you an indication maybe what might be going on or where sentiment really is. For example, a really interesting one is if you pivot over to Ether and you look at the long-short ratio, hitting not only year-to-date highs but trading at one of its highest levels in months. I think it's 5 or 6 months now. Typically that's preceded a pretty substantial dip in Ether prices in the short term after that, right? So those are the types of things that we're looking at, and we included some of that in the short-term outlook for our Ethereum report that we released last week, which is a great segue to bring in our other partner here, Medio DeMarco, who helped lead the kind of effort on this Ethereum report. Got a lot of really good feedback, but definitely wanted to dive a little bit deeper into some of the highlights of that, and then we'll address some of the questions that have been raised about that report itself. So with that, I'll hand it off to Medio.
Thanks, Kev. This is Medio DeMarco from Delphi. In terms of our Ethereum report, one thing that we wanted to address in our short-term outlook was a focus on treasury liquidations. And this is analysis that, once we started digging into, others in the space had done similar things themselves, but there were a few key issues that made us want to do a proprietary analysis in-house regarding the topic. To start, to understand how much a treasury has left to sell, you really have to have a good number of what they raised and what their starting point was. When we looked at other, data in the space, what we found was that a lot of it was just taken from headlines and not necessarily confirmed on chain. So what we did was we picked through 54 of the largest ICOs. Altogether, they raised about 16.2 million ETH. So the vast majority of all the ETH that was raised. And what we wanted to do there was we went project by project and confirmed during the token sales, considering private sales, pre-sales, what have you, what was their peak starting balance. And can we verify that on chain? So that was our starting point to begin with. A second problem we found with other analysis was that while they did track outflows from, let's say, a project's multi-sig or many of their multi-sigs, that's where the analysis kind of stopped. It was just, okay, let's assume money flowed out of that address. That means that money was sold. And that wasn't, we wanted to get a little more granular. So what we did was we partnered with a firm called Bloxy, who does blockchain data analytics. And one of the tools that we really liked that they had was that when providing an address, they could track all of the ETH that flowed to an exchange over time. So, not just money that was sold directly from a treasury, but also money that, to give an example, let's say the treasury paid their CEO an ETH, that CEO moved it to another address, and then that ETH from that other address was then sent to an exchange. That was captured in our analytics. So it gave us a really good picture of how much money was raised and how much money was sent to an exchange or eventually was sent to an exchange. And that was done 8 hops deep. And we found that the vast majority of all transfers were done by 8 hops. So that was adequate for our analysis. Touching on where we are right now in terms of how much was sent to an exchange versus was raised. As of the end of February, about 60% of ETH that these projects had raised was sent to an exchange. And it's important to note that a bulk majority of that is coming from, the EOS token sale, where, a little over 70% of their total raise was eventually sent to an exchange. So once we had that analysis in mind, one thing that we wanted to do was also, how can we extrapolate this forward to get an idea of potential selling pressure in the future? So what we wanted to do there was, it's clear that token sales have kind of cooled off since the second half of 2018. So what we wanted to do there was, is there another, potential category or theme that could drive, retail buyers to, start buying up ETH? Because the ICO boom was one of the main drivers for why, the ETH price started to really, really skyrocket in 2017. And, one of the biggest topics in the space right now is decentralized finance. So what we wanted to do was we wanted to see, okay, how much ETH had been locked up in DeFi? What was that growth rate? How much Ether is left in these treasuries to sell? And then basically project forward, reasonable assumptions for how fast DeFi could grow, how much of that growth could be attributed to new sales. And then on the flip side, in terms of selling pressure, we wanted to forecast, how much ETH was left to sell from these treasuries. In addition to another thing we wanted to incorporate was new supply coming onto the market, because, in a conservative way, it's reasonable to assume that a lot of the ETH that these miners earn is sold to fund their operations. So taking all these factors into account, we projected forward 2 different scenarios based on different assumptions. We can, both of which are highlighted in our report. And if you're interested, we can send more info on both. But on average, moving forward, per month net selling pressure, we have at roughly 400,000 ETH in fundamental net selling pressure moving forward, and we forecast that out to the end of this year. So we have a really good sense of how much potential selling pressure still exists and what impact that could have on the price. It's easy to look at the analysis we provided and try to overlay price on top of that, and just looking at the chart. Months where there wasn't a lot of net buying pressure certainly lead to price spikes, and months where there was certainly a lot of selling pressure, you could visualize that's where the price kind of fell off a cliff. We did some correlation analysis and found that there wasn't really a strong correlation there, and the sample size is just not large enough to really say that this fundamental net buying selling pressure really is predictive of price. If anything, we almost found that it was the other way around, where the more price rose, the more you would assume treasury sold, and that also makes sense logically.
Thanks, Medio. Hi, this is Jan Lieberman again. So one of the things we looked into was the long-term sustainability of the currently proposed model, and we looked at it both from a gross yield perspective, and then we factored in costs based on both a cloud and hardware setup. And while our costs might have been a little bit on the conservative side, because we kind of wanted to model it from the perspective of a casual individual looking to stake the 32 ETH to become a validator, and not so much from a large-scale validator, it really shows how difficult it is to kind of achieve profitability based on the current specs. And we looked at the variety of scenarios we've shown, make it clear that the currently proposed yield will be insufficient. And it's reasonable to assume that certain stakers, you'll have Vitalik and other initial founders will stake regardless of the economics. We don't believe that this is, however, the most reliable path to long-term sustainability. And based on the current setup, economic sustainability is predicated on a developed fee market, and just introducing 1,024 shards, even at current prices, we don't really see how that can develop right off the bat. So while we absolutely believe that continued Ethereum adoption and building on the platform will help the fee market develop, it kind of becomes a chicken or the egg type situation. So on one end, you have a diversified and profitable validator network is crucial for security and longevity of the network, but it's hard to see how that's attainable with the currently proposed specs without the significant network fees. And at the same time, expansion of network fees will only really occur with substantial DApp growth and general adoption. And it's difficult to see how you'll have all of that if it's being built on a network that isn't really considered secure. So what we propose is a change in the issuance model with a higher, an accelerated issuance policy early on, and then it gradually declines over time so that you have the initial portion of revenue to validators being made up more of block rewards and less of fees, and then over time, as the network as more is continued to be built on the network, you'll start to see that dynamic shift, and you'll have both block rewards coming down based on our proposed policy, and you'll have just naturally increasing network fees from continued adoption and building on the network. And we recognize the arguments here against a higher issuance rate, particularly the dilutive effects it might have on holders. But in this situation, we think it's definitely an idea worth exploring, especially given its significant effects on long-term security of the network. And we don't believe that security and economic sustainability have to come at the cost of high issuance, in the sense that it's not really a binary alternative. And in our proposed model, we model out how it's only a marginally higher issuance rate, and over time that ends up being relatively mute. But the benefit is the increased net yield, especially early on, would really help bolster the security of the network from the beginning, and allowing what we believe is a more natural trajectory in fees to come take its course. On the topic of Serenity, I'll transition back to our partner Medio to discuss the scaling solutions that are being proposed for this upgrade.
Thanks, Jan. That's a very good deep dive you just did on Serenity and the economics, but there is a path to Serenity that we have to address, and the time frame and the features that come with it. We'll keep this at a high level just because this part can get very technical, but for reference, please refer back to our report, which has a lot more detail in that. I'm going to basically address two different topics in terms of scaling solutions and upgrades in the near term. One is a broad category of upgrades referred to as Ethereum 1.x, and these are expected to occur from 2019 to 2021. And these are really just fixes on the current Ethereum 1.0 mainnet to keep it sustainable and usable leading up to Serenity. And then moving on to that will be Ethereum 2.0 Serenity, where we will discuss the time frames for different features and what that means for the network. So just talking about Ethereum 1.0, these are expected, like I said, over the next from starting this year leading up to 2021. And really what these are focused on are largely helping to mitigate the increase in the size of the Ethereum blockchain. Just going off of numbers as of the beginning of March, a full node, depending on whether you're running Geth or Parity, is somewhere around 190 to 150 gigabytes, whereas an archival node is far larger, and that's around 2100 gigabytes, or give or take. So that's a clear problem in terms of decentralization. It makes it harder to run a node, and we've seen that with projects like Infura really being the a lot of projects choosing to work with that rather than set up their own infrastructure on their back end. So for Ethereum 1.x, some near-term solutions that they might be adding that would help address blockchain size, state rent, basically charging users money for storing data on the blockchain. Now that might be contentious because if rent can't be paid, that data would be removed, and that's a big change because as it stands now, data that's put on the blockchain stays there forever. But logically, it's not it makes a lot of sense because if you make it so that anyone can put blockchain data on the blockchain for free, and that's supposed to be held there in perpetuity, that cost just transfers on to the people running the nodes. The people have to store that data forever. So there are some strong arguments for why that makes sense, and it certainly would help cut down with the bloat of the blockchain. And then another topic, another solution on the same topic, storage pruning, and that's just basically slimming down different ways to trim and compress, what nodes have to store in terms to keep operating. So that's at a high level Ethereum 1.x. Moving on to the transition to Serenity. This all starts with the launch of the Beacon chain, and that's expected to be in Q4 2019, Q1 2020 at the earliest. And this really kicks off the entire process. Beacon chain is going to be the new proof of stake chain, and it's going to be the linchpin for the entire sharded network moving forward. It's going to coordinate everything. It's going to keep track of the validators and their balances, what have you. Now, to kick off the start of the Beacon chain, there is this transition period where a minimum of roughly 500,000 ETH need to be sent to the new chain and locked up. And then from there, once they've hit that threshold, that thing will begin going live. The transition period is an interesting topic. There's one main area that I'd like to highlight, and that's really focused on once as a user, if you move your Ethereum from the current 1.0 mainnet to the new Beacon chain, right now that's a one-way transaction. So that Ethereum could be locked up for let's say 2+ years, and there's risk that comes with that. It's hard. It's difficult to say how many people will rush to lock up their money. So there are talks about making it a two-way bridge and what have you, and the consequences that could result from just having it being one directional, because then you have essentially two different coins. You could have futures markets that develop around that, and it could make it a lot messier than maybe a lot of people realize. So that how the transition to Serenity is modified and changed leading up to it over the next few years, that'll be important to watch, because that'll have a big impact on how much ETH is staked there to launch, and what the incentive structure is around the early day security. The Beacon chain will not have phase 0, which includes the Beacon chain launch, will not have sharding implemented right away. That won't happen until the next phase, and that's right now estimated to be sometime around 2020. And then phase 2, which is the full functionality, that's estimated by the following year in 2021. These are the current outlines as they stand now, but Ethereum has pushed back upgrades deadlines in the past, so it'll be important to watch development, seeing if they can hit these targets. But even at the current time frame, to be conservative, give them the benefit of the doubt and say they hit all their deadlines, that's still quite a while away for a truly decentralized, scalable blockchain. And there will be a lot of competition launching in the near term before that's fully live. But we do like Ethereum's long-term plans to focus on staying decentralized, the solutions and the things they've taken into account. So it's not to say we're bearish because we think the transition will take a while, but we are cautious, and it will be important to watch viable competitors emerge on the scene that maybe can maintain the same level or maybe even a better level of decentralization while offering scalable alternatives. But Ethereum will have Ethereum does have the biggest network effects as it stands right now in terms of developers. So it will be hard to displace regardless. And speaking about competition, I'm going to transition over to Tom now, who's really going to dive into this topic and add a little more color there.
Thanks, Mateo. So basically, there's a lot of competition in this space for smart contracts and developers, and one of the main competitive forces we're seeing is Tezos, Polkadot, and Cosmos. So one of the main items we like to point on is there's a lot of hand-holding in the crypto community, especially between smart contract platforms, whether it be Ethereum, Polkadot, Cosmos, Tezos, etc. We expect this to switch to a very competitive landscape over the next 12 to 24 months, where developers and stakeholders of these protocols start actually competing with each other versus basically trying to work with each other. So we saw the launch of Cosmos this week, which is actually accepted by the Ethereum community because, unlike Polkadot, Cosmos allows stakeholders to basically maintain, or allows other blockchains to maintain their sovereignty. It doesn't push consensus or governance ideals on the other blockchains. Whereas on Polkadot, run by parachains, dot holders basically make all the decisions of the network. So it's definitely a different interoperability dynamic between the two chains. So I definitely consider Cosmos as less competitive to Ethereum than Polkadot. So beyond just the normal governance debates there, the main reason why Polkadot is more competitive to Ethereum than Cosmos is because Cosmos is basically a hub and spoke model, basically focused on token transfers and exchanges of value. Polkadot is focused on being a platform where dApps, smart contracts, and use cases can be built in place of being built on Ethereum. And there's over 25 projects being built on Polkadot in the beta stage. It hasn't launched yet. It's going to launch in about 2 or 3 quarters. But the main selling point for Polkadot to drive home this competitive nature is the launch of Substrate. And you can think of Substrate like a drag and drop type dynamic, kind of like on AWS, where you can drop in a consensus algorithm, drop in a treasury algorithm, edit block rewards, et cetera, to make it really easy to launch new blockchains and new decentralized apps. So I definitely would consider Polkadot more competitive to Cosmos. But in the nature of crypto and blockchain, Cosmos drives us to the next level because it allows us to build decentralized apps, smart contracts, and use cases that leverage different blockchains that basically vary different trade-offs in the blockchains to make it work. So we could have high throughput on something potentially like EOS, and we could merge that with a use case on Ethereum to create new use cases. That's known as composability, but I would more point to that as being interoperability at that stage. So switching over to Cosmos, Cosmos allows you to stake your Atom tokens for a yield between 9 and 16%. That kind of plays in well with the generalized mining insights report we released this past week. Basically, the whole point of generalized mining is to bootstrap networks beyond financial investments to help drive the success of these networks. It has not been quantitatively proven that bootstrapping a network beyond financial incentives can actually help drive a network to success. The main things we point to there is that beyond making an initial investment, it's very early in the space to do that. Tezos obviously has a huge staking community, but it's yet to be seen if that's actually driving, say, developer usage and smart contracts beyond simply securing the network. But generally, we think that the space is evolving beyond staking. So you're seeing things like live peer, where stakeholders can take one of 5 different roles to earn tokens to support the network and do different responsibilities. Beyond simply bootstrapping the networks, we believe generalized mining can bolster fund returns, whether it be offsetting inflation or whether it just be adding to the returns, potential returns of the token appreciation. This can be between anywhere from 10% on Decred, 9% on Tezos, or as high as 150% on live peer. Obviously, there are more significant risks involved with staking on live peer. So generally, we've been following generalized mining closely. We think it's going to evolve, and we think they could help drive returns above and beyond tokens, potentially for individuals and for funds.
Hey, Tom, really good points here. And something that we got a couple of client questions on that we'd great to address now would be, how do you see, you started touching on this a bit, but how do you really see the risk-return trade-off in generalized mining opportunities, today?
Thanks, Kevin. Yeah, it's a great question. So we explored 3 different scenarios in our generalized mining insights report this week, basically on the potential returns from additionally staking as well as investing. So we kind of built out 3 models based on investing $10,000 in Tezos based on different token appreciations and interest rates depending on the prevailing staking yield. Basically, in our 3 different models, it's a big difference. So it's basically a difference of 50 or 60% in potential returns in our scenarios. In our example 1, in our second example, we kind of explore interest just offsetting inflation. And in the third one, we explore a hedging strategy where we take the interest from staking and invest that in another different uncorrelated asset to help diversify the investor's portfolio. Now, these are potential scenarios, and we'd like to point out that there's obviously a lot of risks involved with generalized mining. One of the main one that's pointed out is that you're obviously more central or more concentrated in a specific investment. The second one is a lot of early generalized mining opportunities could not pan out. The best example of that is Grin, where something like $100 million in VC money lined up to support mining, and that network basically did not take off as many would seem, especially in competition with Beam and the larger privacy coins Zcash and Monero. I'll put it back over to Kevin so we can discuss additional questions.
Great. Thanks, Tom. Thanks for hitting on that. So finally, to round us out here, it wouldn't be a monthly analyst call if we didn't talk about one of the best performing crypto assets in recent weeks this month, which is Enjin coin. And so here to kind of walk us through that and give us some additional context on Enjin as the lead analyst on that, Anil Lula. Anil, stage is yours.
Hey guys, it's Anil from the Delphi team. Thanks for that, Kevin. So basically, as most of you know, timing really worked in our favor with the release of the Enjin report. When we dropped the report on February 18th, Enj was around 3.5 cents and 900 Satoshis. A little less than a month later, Enj stands at 17 cents and 4,300 Satoshis as of today. We're recording this on March 14th. So this represents 566% return from a USD basis and a 477% return on a Bitcoin basis. At its peak since we dropped the report, Enj got up to over 24 cents and over 6,000 Satoshis. So I know a lot of questions we received for this analyst call was around what's happening with Enj, what's going on with it currently. So I'm going to try and cover that within this section. But before I do that, I wanted to give a quick overview of what Enjin is, what their team's trying to accomplish, and a little bit more for people who haven't had a chance to read our report yet. So as we say in our executive summary, Enjin Coin is an ecosystem built on Ethereum that facilitates the development of blockchain-based games. So basically, Enjin, the company behind Enjin Coin, they've existed for close to a decade now, and they're based out of Singapore. Their company hosts over 300,000 gaming communities and over 20 million gamers. So our team felt as if the team had the necessary experience and understanding of the gaming space to really make an impact. So Enj, their token, is used within their ecosystem to create and trade blockchain-based game items. The value of Enj is heavily dependent on the number of game developers backing their in-game items with it, effectively kind of locking up these Enj. So if you haven't read through our report yet, we walked through a pretty in-depth valuation model where we calculate a range of potential prices for Enj based on assumptions we viewed as reasonable. So the key value driver we try to outline throughout our report was how Enjin is placed to focus on developing not just one product, but an entire gaming ecosystem, right? So this ranges from a universal blockchain explorer called Enjin X to SDKs for popular game engines, and even an off-chain scaling solution for Ethereum they're working on called Affinity. So one piece of their ecosystem, which actually received a lot of attention over the past month, was their wallet. I'll touch on that a little bit later. So the ecosystem their team is developing played a huge role in kind of getting our team comfortable with some of the key concerns for this project. This includes competitors like Loom, which we've received a lot of questions about. So we decided that we're actually going to make that a token report we release to our clients this month. But their ecosystem also helps Enjin see some traction when it comes to mainstream adoption. So interestingly enough, we're recording this call on March 14th, which is also the date Enjin recently announced they'll be added to Unity's assets store. This is a huge catalyst for Enjin, as this puts their tools in the hands of over 4 million Unity developers. So as I mentioned earlier, the value of the token is heavily dependent on the number of game developers backing their in-game items with it. So having the most popular game engine SDK go live for them is a pretty big deal for them. So that being said, this kind of brings us to the question submitted by a few of you regarding what's going on with the token Enj. A week after we released our report, a rumor went around that Enjin's wallet would be used or white labeled and installed on Samsung's S10 phones. This all came from a picture someone tweeted out about Samsung's crypto wallet, which included an Enjin logo. Like we said in the note that we sent to clients that day, after Enjin tripled, there was no confirmation from either team about the partnership. This triggered a buy the rumor, sell the news type event where investors in the market who had been, kind of hungry for a coin that could actually accrue value had, a catalyst they knew others would kind of FOMO into. So despite no confirmation, media outlets in South Korea picked up the story, and this sent Enj up even higher, while both Samsung and Enjin's team kind of stayed quiet and didn't confirm or deny anything. So on March 5th, Enjin's team kind of finally broke their silence, but it was really just to announce that their SDK for Unity was due to launch on March 14th, so this kind of led to another run for the project over the next few days of over 100% returns on both USD or Bitcoin basis. Doesn't matter really what you looked at. So shortly after that announcement, Enjin's VP of Marketing, Simon, finally confirmed an official partnership with Samsung, although he was saying he wasn't at liberty to disclose any other information at this point. So since then, people who have actually been able to get their hands on the new phone and play around with their wallet have confirmed that while the wallet is not Enjin's wallet, the Samsung wallet does come with support for 2 dApps straight out of the box. First is CryptoKitties, which I'm sure you guys are aware of, and the second is Enjin's wallet. So to kind of summarize what's happened over the past month and what we can confirm, Enjin's wallet is one of 2 dApps that Samsung's wallet has intrinsic support for. This is obviously a big deal, but I think Enjin is kind of in a rare position to capitalize on this partnership in a unique way that most other wallets wouldn't be able to. So I don't want to spend too much time on this here, but if you read our report, you'll see that Enjin's wallet is actually pretty impressive. It has a kind of slew of features that will help in distributing their items to users who they can hopefully convert into players of games built using Enj. So one section that I can point you guys to is probably the airdrop QR system that they developed called Enjin Beam, which is a really cool part of their wallet. And as I mentioned earlier, the second thing that's really happened over the past month is that Enjin will, or depending on how the rest of today goes, might already be listed on Unity's asset store by the time you hear this call. This will allow millions of developers around the world to get access to Enjin's tool and start building games with blockchain-based items seamlessly integrated. So to clarify, our team tried to time the report of Enjin with when we expected news around the launch of their Unity SDK. They've been talking about it for months now, and as we mentioned in our roadmap section, they promised it'd be coming in the first half of 2019. That being said, we had no intel or knowledge about the Samsung rumor, and to be honest, we just got lucky with timing on that. So given that Enj is up over 5 times in less than a month, we understand some of you being kind of hesitant to kind of enter right now. While the listing on Unity's asset store should kind of be one of Enjin's bigger catalysts, we can't be sure given how a lot of recent holders of Enj have probably bought in solely based on the Enjin wallet and Samsung partnership. Even reading through the Telegram group, it's easy to see that there have been kind of an influx of people who've joined without any real understanding of what Enjin's trying to accomplish. So while we still remain constructive on the long-term value of Enjin, even at these levels, we believe the recent run-up in price might be a bit stretched given how fast this move really has happened. That being said, we'll definitely keep sending across relevant notes for any big developments for any of the projects we cover. And as always, if you have any questions, please don't hesitate to reach out.
Great. Thanks, Anil. So we had a couple questions that we weren't able to kind of loop in earlier, but we definitely want to hit on from some of you out there. One of which that we want to touch upon again with this Cosmos launch this week that Tom was discussing earlier. Tom, bring you back in real quick. How is this going to interact with Cosmos and Bitcoin? What does that relationship potentially look like?
Thanks, Kevin. Yeah, it's a great question. It's going to come up a lot. It's early stages, so we're yet to see the full impact yet. But we believe interoperability can allow Bitcoin to be used on other chains as a digital or financial asset. So whatever the use cases, smart contract, prediction markets, et cetera, you can build new use cases with the base asset of Bitcoin instead of Ethereum. And we've seen Ethereum be used as the primary base asset for a lot of DeFi type use cases. That can change with Cosmos and BTC. So just think of Bitcoin as the underlying asset, and then you can use other dApps and smart contracts from other chains per se to build out new use cases. And with that, I'm going to go back to Kevin here.
Yeah, wow, that's really interesting. Definitely something we're going to continue to watch and continue to monitor. And speaking of Ethereum, another question that we've gotten, and not necessarily pushback, but it certainly sparked some discussion. Since we've released that Ethereum report, is looking at the kind of dynamic nature of the issuance rate. And so, what I want to do really quick is bring Jan back in. And Jan, do you have any thoughts on some of the questions we've gotten on the dynamic nature of that issuance rate over time?
Yeah, and I think this kind of relates to just general macroeconomics in general, where predictability is more important than a lack of change, and especially in this case, purposeful and predictable change which actually is a feature that ends up helping Bitcoin become a true store of value. Will be a massive asset for Ethereum.
All right, great. Well, thanks, guys. And thanks, everyone, for tuning in. That's going to conclude our March Delphi Digital monthly analyst call. We're going to be doing these each month, but we're actively pursuing, and toying around different ideas and different mediums to connect our institutional clients, here with our research team. So if you like this format, fantastic. If not, definitely reach out to us and let us know how we can improve. We're always looking for feedback. Until next time, this is the Delphi Digital team signing off.